You'll often come across two broad styles of investing mentioned from time to time: value investing and growth investing. Let's look at both in turn. Value investing gets its name because it involves looking for companies that may be underpriced compared to their underlying fundamentals. The thinking here is that the stock prices have more upside potential because eventually the market will realize that companies are underpriced, money will flow towards the stock, and therefore drive the price up. There are numerous ways value investors might try to ascertain whether a company is a value stock. They may use a stock screening tool to look at certain metrics like share price versus book price, for example. By comparing the price to book value of a company against other similar companies, you might notice that company has a much lower price to book ratio than its peers. The next question would be to ask why. Maybe there was a recent scandal at the company that the market didn't like. If you think the company can get back to business and past this scandal, you might see this as a value play. There are many metrics that investors might consider, like the price to earnings ratio, or PE ratio for short, the debt to equity ratio, and more. Some investors simply look for the dividend yield of companies. Whatever metrics you are looking at, you should know that they only provide part of the story. Sometimes what looks like a value play is really a value trap instead. This essentially means that the company's price looks attractive because something is indeed wrong with the company. If we turn to growth investing, this strategy involves looking for companies that have shown higher than average growth, or the potential for higher than average growth. These tend to be younger companies that have come onto the scene relatively quickly. For example, many of the internet giants would fall into the category of growth stocks. They have only been around for a few years or a few decades, but are now some of the biggest companies in the world. When a company has shown the ability to grow revenues and profits so quickly, that's very attractive, and the share price will have shown some spectacular gains as a result. The big question is, will that expectation of growth play out? Growth company stocks can be bid up very high by investors because they are expecting great things. If those great things don't happen, those lofty prices can fall hard. It's not uncommon for some investors to strongly identify as value investors or growth investors, and there are lots of debates as to which style is better. Other investors don't get too caught up on only sticking to one type of stock picking and may choose to look for both value and growth stocks to hold in their portfolio, along with many other criteria they might use when deciding what investments to hold overall.